Someone so prolific, influential, and giving of his time and his knowledge, someone who really needs no introduction. Michael Saylor is the reason we are all here in this room today. When most corporate leaders were ignoring or dismissing Bitcoin, Michael stepped forward, putting his balance sheet and his reputation on the line. It's never easy to be the first to do something, but Michael Saylor did just that. He didn't just question the system and point out its problems. He found a solution, a better way, and he acted boldly, publicly, and with laser focus. Such courage and conviction is scarce. He's proof that it's never too late to reinvent yourself, not for personal gain, but for purpose, to serve a mission greater than yourself, greater than really all of us. He didn't just architect a new corporate playbook, he sparked a movement. And today he inspires thousands of business leaders from around the world to think independently and to think long-term. I've come to know Michael as the most generous teacher, one who cares deeply about principles, about freedom, and about helping others achieve economic empowerment. And while he's known for his insatiable appetite for Bitcoin, his most powerful contribution might just be his brilliant ideas, and it's ideas that endure. Nothing is more powerful than an idea whose time has come, and I can't think of anyone more skilled at spreading the powerful idea of Bitcoin than him. So please join me in welcoming the Executive Chairman of Strategy, Michael Saylor.
I am delighted to get the opportunity today to speak with you about my favorite subject, which is Bitcoin for corporations. Why should your corporation recapitalize on Bitcoin? And leading up to this presentation, I had my team, my talented finance team, working alongside my three devoted AI assistants, do a lot of research in order to explain this topic to you today. So I want to start with the challenge that every company faces. If you've been living in the 21st century, you know that the winners are the digital monopolies. Apple's winning, Meta is winning, Google is winning, Microsoft is winning, Amazon is winning. The more unpleasant part of this observation is that the price that we pay for Amazon to win is 20,000 retailers have to lose. And the price we pay for Apple to win is 20,000 device manufacturers have to lose. And the price that we pay for Google to win is 20,000 journalist organizations, media, newspapers have to lose. And you can see from this chart, the Magnificent Seven are certainly winning. The 500 greatest companies in the world, that is, out of the 400 million companies on the planet, the 500 greatest companies in the world are getting smoked by the Magnificent Seven. They're struggling. And I spent many years in the public market. If a public company can't grow organically 15% a year or more, institutional investors lose interest. The liquidity in the stock dries up, the liquidity in the equity disappears, and then the options disappear. And I remember when it used to be everybody's dream, I can't wait to go public. Start a company and your idea was, if I could just go public, I will have made it. And what I'm saying is going public is just the next step. But what you find is even if you do go public, unless you can keep up with the Magnificent Seven, you're not making it. Another way to look at the world today is in the public markets, most companies in the public market are what I call zombie companies. They don't have much liquidity. They don't have an options market. They can't beat the S&P index. They can't retain earnings. They can't raise capital. They can't take risk. They're trapped in this paradigm where the capital is toxic, volatility is toxic, inflation is toxic. And this is the dilemma that we face. You can actually see it playing out if you look at a list of publicly traded companies over the past 20 years. This is publicly listed companies in the US, and you can see how they've been getting ground down. It's not a chart of success. If I showed you anything in the modern world and the chart went down and to the right, you would say this is failure, or this is a gradual progressive slide to malaise. We're just not creating healthy companies. Now, it's not just public companies. If you take a snapshot of all the companies in the world, there are approximately 400 million companies in the world, small private companies everywhere. There's 400,000 large private companies. There's 40,000 listed companies in the world. 4,000 listed companies on the major exchanges in the US, the NASDAQ, the NICE. 400 seasoned issuers. And probably many of you don't actually, how many people in the audience know what a seasoned issuer is? I'm interested just for my own awareness. Okay, you're going to learn something new today. A seasoned issuer is a public company that is deemed seasoned enough, mature enough, to be able to file a registration statement with the SEC and sell securities the same day. So another way to say it is 400 companies out of 400 million companies can raise capital in the United States and the world's greatest capital market without friction. It doesn't seem quite egalitarian. 400, one in a million. One in a million. It turns out that 0.06% of the businesses in the US are able to tap the capital markets. So if you're in business and you're struggling, the conventional wisdom is if you were just better and worked harder, you'd be succeeding. But you can see that the traditional capital markets, they're structured to be exclusionary and elitist. Maybe this has gone back thousands of years. You can definitely trace it to the SEC Act of 1933 and 1940, when the intent of the act was to cut off access to the capital markets to businesses deemed to be, quote, too entrepreneurial, unquote. So here's the hard truth about publicly traded equities. If I expand my view from New York Stock Exchange and NASDAQ to, all the over-the-counter publicly traded securities, there's 12,000. Of those 12,000, 15% can beat the S&P index. 15% beat the index over the course of a decade. 12% of them have a stock that's got more than $10 million a day of liquidity. 83% of all the trading volume in the stock market in the United States is 100 stocks. When you watch CNBC and it's like NVIDIA, Apple, Google, Meta, NVIDIA, Apple, my opinion of Apple, my opinion of NVIDIA, my opinion of the 2x NVIDIA ETF, Apple, 2x Apple, NVIDIA, Meta, gold, Bitcoin, Bitcoin, Bitcoin. And if you're waiting for your favorite company to pop up, it's not going to pop up because the television knows that people just want to trade these 100 things. 8% of those companies have an option market. 8%. Okay, here's the painful one. All of the wealth created in the stock market comes from 4% of the public companies. 96% of these companies have performance equivalent to a treasury bill. That's brutal, right? 96% of the companies can't beat a T-bill. Here's a snapshot of stock performance of the S&P. So we pull the 500 companies. These are the greatest 500 companies in the world. Look at them on this distribution chart. what you can see is that the Magnificent Seven, they're up 221% over the past 4 years. S&P is up 67%. 96% of the S&P companies are underperforming the Mag 7. 96%. 68% can't beat the index. Bitcoin is for the rest of us. It's for the 96%. If you're not Apple, if you're not Google, if you're not Microsoft, then you need to come up with a strategy. And as you can see, it's probably not going to be working harder. Here's a distribution of those companies based on market cap. The average S&P company, $35 billion market cap. The Magnificent Seven, $2.4 billion. So they're not quite 100 times bigger. You got 7 companies that are 100 times bigger. You've got all these other quote unquote big successful companies. They're at 1 to 2% of the size of the winners. This is liquidity, you know, and so if you're looking at liquidity as a percentage of market cap, what you can see is that the average is 1%. So 1% of your market cap is liquid every single day. Our company, of course, off the chart, 7%. Here's volatility. Well, business school teaches you volatility is a bad thing. And so everybody's sent out of business school with a mission to strip the volatility from the balance sheet and then spend their entire life stripping the volatility from the P&L. And you could almost say they succeed. I mean, they've done a pretty good job. Look how many have volatility less than the S&P index. You know, by the way, who has more volatility than the S&P index? Every rich person you admire. Every wealthy person in the world has volatility more than the S&P index because they didn't strip the volatility from their balance sheet. Bernard Arnault and Jeff Bezos and Mark Zuckerberg and Elon Musk, the people that we're supposed to aspire to, have massive volatility. And yet these great, well-run companies in the world are going out of their way to strip their volatility. The number one way to strip your volatility away, by the way, is give away all your money. Like if you want to strip the volatility from your family's balance sheet, give all of your family's wealth to charity. If you want to strip the volatility off of a company, then you take all of the capital, all the cash flow of the company, and you either buy back the stock or dividend it out or give it to somebody else. And it works. But again, the idea, it's kind of, you almost can't make this stuff up, right? When you present it that way, it's I have a strategy. If I just give away all my wealth, I don't have to worry about losing it. Think about that. Here's a distribution of open interest. This is the interest in the options market as a percentage of market cap. And what you can see is maybe people want to trade Tesla and NVIDIA. I mean, they read about them, we speculate about them, we gossip about them. There's something to trade there. But, you know, for the most part, the S&P 500 has very small open interest, and companies that are small in the S&P oftentimes don't have any option market. Billion-dollar, multi-billion-dollar companies, there is no option market. And by the way, if your strategy is get rid of all the volatility on the balance sheet, you'll never accidentally make $50 billion like Elon Musk does or like Jeff Bezos does. You'll never accidentally have anything you own trade up. And if your strategy is strip all the volatility from the P&L, we'll just sign our customers to 3-year enterprise agreements and renew them a year in advance and put a CPI or PPI escalator on it. Once you've done that, the question is, why would I bother to ever trade the stock? I could tune in once a year, make a decision and forget about it. The only volatility you're getting in that case is negative volatility when something goes wrong. And this is how that strategy transforms the performance. Note that by stripping away the volatility from the P&L on the balance sheet, the companies also effectively strip away the performance. And you can see how our company strategy is an outlier here. There's a few sparks. But for the most part, and again, this is the top 500 companies, we're struggling. And another way to say it is most companies, they're struggling to compete and they're dying slowly. 85% of the US listed companies have less than $10 million of options interest. 75% have less than $10 million in daily trading volume. 85% are destined to underperform the S&P 500. So if you're in one of those companies or you're running a company or you hope to start a company, the issue is, how do you break free? How do you actually overcome this structural disadvantage? Everybody in the world talks about AI. If you walk down the street and you asked 100 people, do you think AI is a good idea? Most of them would say yes. Every CEO's got an AI plan. Every investor wants to know your AI strategy. And it's sexy and it's fun and it's critical, but it's not the solution to the problem. AI is not the solution. Why? Well, first of all, because everybody agrees that you should use it. Everybody agrees. It's a consensus idea. Everybody agrees you should use AI to cut your costs, improve your products, and grow your business. We all agree on it. Well, that just means 400 million businesses are all agreeing to use the same technology to do the same thing at the same time, right? Where's your edge? Here's what's going to happen with AI. The rich are going to get richer. The famous are going to get more famous. The powerful will get more powerful, right? This is going to be a big benefit to Microsoft and to Apple and to Google and to all your famous celebrities, and to Tom Cruise. If you've got a famous brand, if you've got a distribution channel, you're the beneficiary, those with money and power. And however, if you're trying to start something up, there'll be 10,000 AI startups, 100,000 AI startups, a few AI unicorns. And when I say unicorn, I mean 1 in 10,000 companies. There'll be a 99.9% failure rate or 99.99% failure rate. But you'll have some pure play AI unicorn startups, and they will disrupt entire industries. They will destroy thousands of companies. They will change the world. You'll have robots making robots. You'll have someone launch some product to provide the work of 187,000 accountants. You'll have interesting things. Many will fail, but something will succeed. But here's the bad news. It's more likely that your company will be the victim of that trend than the beneficiary of that trend. At the end of the day, this is a steamroller. It's coming. But if you're not the unicorn, and if you are not the digital monopoly or the most powerful company in your country or in your industry, then AI is feeding the rich and powerful. It's not feeding you. It's just turning the screws to you. So consensus thinking, it won't elevate the average company. AI, it's not that it's a bad idea. It's a good idea. AI is a necessary condition for success. You won't stay in business a decade from now if you haven't embraced it. There's no doubt. It's a necessary condition. It's just not sufficient. It is necessary, but not sufficient. You have to embrace it, but it's not going to save you. Bitcoin is the solution to the problem. And why? Well, because very few people agree. Because most people don't think it's the solution to the problem. Few agree that you should use Bitcoin to capitalize your business. Now, you don't have to take my word for it. You can literally go out on the street. You can ask 100 wealthy, well-educated people. Go ask any, business school professor. The majority will say, it sounds risky, not a good idea, increases the risk. You go ask the same people, should I use AI in my startup? They're like, absolutely. Okay. The consensus technology is digital intelligence. The paradigm shifting technology is digital capital. Digital capital will save your company because everybody else doesn't understand it, because the mainstream has not yet embraced it. You get to be first. Or in the words of Peter Thiel, and this is probably the most important quote I'm going to put on the screen today, courage is in much shorter supply than genius. I can show you geniuses. There's 8 billion people on the planet. You can find 8,000 people that are the smartest one in a million. You can't find 8,000 courageous businesses to do what I've described. You might think that you've got an IQ 200. You know what people with IQ 200 do in this world? They come up with 100 reasons to not buy Bitcoin. They come up with, they can write books, everything that can go wrong. Well, I can hypothetically imagine that this might be a problem 10 years down the road in that circumstance, and so that's why I will not do it. People lacking courage apply their brilliance to apologize for why they're not going to take the risk. And so this is not about being smart. This is actually about having some courage to acknowledge reality. I was just showing you some reality, right? Is your business going to all of a sudden start growing 20% a year forever and like grow past the Magnificent Seven? Well, again, if you haven't acknowledged that reality, then you won't embrace a new idea, right? You're not winning in the status quo. You need a paradigm shift. Embrace the new idea. Then you have to do the work. Doing the work requires a lot of study, a lot of research, a lot of careful planning. And at some point after all that work, take a risk. And if you do take a risk, then you have to execute. But your path out of this is acknowledge reality, embrace the idea, do the work, take a risk, execute. And what's it mean to do the work? Well, you're doing work for 40 years of your life. You're working. That's, 80,000 hours of work to make money. The great irony is every single person in the economy spends 80,000 hours working, trying to get someone to spend 100 hours to figure out how to keep their money. That's actually challenging. But what I say is spend 100 hours learning how to keep the money that you generated over 80,000. Now, if you're the CEO of a company with 10,000 employees, I want you to imagine 10,000 times 80,000 hours working very hard and then losing all the money. Well, practically speaking, that's what's going on in the world today. It's going on thousands of times everywhere in the economy. Spend 100 hours learning to debunk the 100 criticisms people come up with. Well, I'm worried about this. I'm worried about that. What if Satoshi is a CIA dude? What if Dr. Evil gets a quantum computer? What if? Oftentimes when people get past the it's tulip bulbs, they go to the argument, well, it's too good to be true, so the government's going to take it away from you. That's literally the giga-brain objection. You're right. It will solve all my problems, but it's going to solve them so well, it's too good to be true. So somebody more powerful than me that hates me will just take it away from me. So I think I'll just not try. After a bit of work, you conclude that money decomposes into capital and currency. The conventional thinker will tell you money is a medium of exchange, a unit account, a store of value, and they'll stop and they'll act like they just solved the problem. It's like, this is why you don't want to teach people to brainlessly repeat stuff that they learned in school. Well, the truth of the matter is, when you think about it, you realize that high-frequency money versus low-frequency money varies. So if I want to spend the money for the next 4 weeks, I'm going to use the peso in Argentina. It's a super, super high-frequency money. If I want to hold the money for 4 weeks to 4 years, I'll use the